Good afternoon. Appreciate you joining us for our second session this afternoon. This session is on a very important topic that is a challenge and an issue that many of our ports are dealing with and look to deal with over the coming months and years. And it's the question of how do you go about really funding and financing your projects. So we're looking at private sector financing, investment, and development initiatives. As you might see on your program, Steve Cernak, our incoming chairman of the board, was due to moderate this session, but unfortunately Steve has had a medical issue that he needed to take care of this week, so he was unable to be with us. I'll be filling in for him. What I'm going to do is just briefly introduce the four speakers that we have, and then let them come up individually, give their presentations, and then at the end of the session we'll open it up for your questions and further discussions. Our first speaker is going to be Joshua Hurwitz. Joshua is senior consultant for Moffatt and Nichols. He has more than 15 years of experience in commercial infrastructure investment, corporate finance, and business development, with an emphasis on the U.S. and Latin American port and maritime industries. His expertise lies in port acquisitions and new concessions, market studies, commercial due diligence, business plan modeling, and negotiating partnerships agreements. He holds a BA in Latin American Studies from Wesleyan University and a Master's in International Relations, specializing in corporate finance from the Johns Hopkins School of Advanced International Studies. Our second speaker will be Blair Garcia. Blair is the Ports and Marine Division Director in the U.S. for WSP. He is experienced in multimodal freight and passenger planning and has led a very diverse number of projects involving the planning of commercial and industrial facilities and corridors, land development, market analysis, cost modeling, financial analysis, capacity analysis, and transportation planning. Blair holds a BS in civil engineering from Clemson University. Tony Renzi concentrates on international and U.S. domestic corporate transactions, including public and private debt and equity offerings, mergers and acquisitions, corporate restructurings, and private equity investments. He is ranked in Chambers USA for capital markets and Norway capital markets. He is also regularly recognized as a leading international capital markets lawyer by Who's Who Legal. And our final speaker will be Mr. Grover Burthey. Grover is Deputy Assistant Secretary for Transportation Policy at the U.S. Department of Transportation. We very much appreciate you taking the time to be with you. Obviously a lot happening in Washington and at DOT, and hopefully as we move toward an infrastructure package, so we look forward to hearing your perspectives on that. In his role, Mr. Burthey focuses on the department's infrastructure and permitting initiatives, among other policy-related responsibilities. He holds an MBA from the Stanford Graduate School of Business and a Bachelor in Economics from the Wharton School of the University of Pennsylvania. So please join me in welcoming our first speaker, Joshua Hurwitz. Joshua?
Okay, thank you very much. Before I get started, let me just say that the commentary and opinions in the presentation are my own. May not necessarily be that of Moffatt and Nichol, its employees. I won't bother telling you about the engineering and design work that we do or the commercial advisory services that we do, but we do extensive amounts, and if you'd like to come talk about it with me, see what we can do for you, please come find me afterwards or visit our booth. So I'll just start off with a survey. Is there anyone in here, just raise your hands, if you have too much money and don't know what to do with it? So I see very few hands. I'm not surprised. In fact, I think it should be the opposite. I'd be even more surprised if you actually admitted that was the case. Let me ask a more serious question. Is there anyone in here who has received phone calls from financial investors who do have too much money and not enough good projects to invest in? So I've received those calls and I see a lot more hands going up. And it's true. So why is that? So I'm going to talk a little bit about that, approach and answer to that by covering four trends that I see in private investment in ports. One is that the need exceeds the capacity of public financing, so we're seeing greater use of private financing and PPPs. The second, within the port industry dynamics are rapidly changing the status quo and causing opportunities and risks to emerge. Three, port authorities, it's important to understand these trends in order to understand how they may impact the various policy goals that you may have. And then lastly, I'm going to talk about a couple of long-term technology changes that I think have the potential to reorder the transportation goods in our country. So chronic underinvestment in global infrastructure has been a consistent headache for policymakers for decades. Some studies put the deficit at $800 billion annually through 2030. I think we all know inherently that there's just a tremendous amount of need in ports, airports, roads, highways, sewers, electricity, water systems, disaster recovery. There just isn't enough public sector money for all of it. Within ports, the investment need is being driven by technology change in the form of larger vessels. Sometimes these larger vessels require more port capacity, but almost always they require a change in the capability of the port, at the berth, in the yard, at the gate, and at the rail yard. So the world is, and has been for some time now, turning towards public-private partnerships to fill the gap. And I've also read studies that say there's upwards of $1.2 trillion of private financing that could be deployed to fill this infrastructure funding gap. But infrastructure funding for the private sector has to generate user fees to pay back a risk-adjusted return on investment for the private investor. One current challenge in the port space and in general is that some investment requirements are now so large that user fees alone cannot substantiate the investment. So that makes it all the more important to thoughtfully structure how you put together a public-private partnership. There are many types of PPPs, and at least 3 distinct public policy categories. There could be many goals within each category. One could be efficiency improvements at the port, as some concessions in Peru have shown. They really wanted to improve berth productivity, yard productivity, some measure of efficiency. A PPP could also be structured to target low user fees. So in Chile, as a matter of fact, it's actually the law that they award competitive tenders to the bidder with the lowest maximum tariff in order to reduce the cost of infrastructure to the users. Almost every PPP these days prioritizes private investment. So that is a public policy goal, is to marshal private investment for building a good, in this case, an infrastructure good. So my advice in general would be to prioritize 1 or 2 goals, PPP goals, and then to try and be flexible on the rest, because as you'll see, the other participants in the partnership have their needs and goals as well. I'm going to talk briefly about the different types of capital out there and different types of investors. I know Tony's going to cover that as well. Broadly speaking, you have 2 types of capital, debt and equity. This is a gross generalization, but it does help to understand the types of questions that you will be asked and the types of risks that the investor will look at. Debt is mostly concerned about understanding the downside risks and making sure that the debt can be repaid even in those downside scenarios. Equity, on the other hand, because they're at the end of the line in terms of proceeds from the investment, they're concerned about whether there's enough upside to justify the risks that they may be taking. Within the types of investors, who's buying in ports, who's investing in ports, there are kind of 3 categories and then many, many subcategories, and probably some that aren't here as well. You have strategic operators, could be a global operator or regional. So within global even you have those, a further distinction. There are those that are affiliated with carriers, like APM terminals or TIL. You could be non-affiliated global operators like DP World, Hutchison, PSA. These are global operators that have multiple terminals, essentially managing a portfolio of dozens and dozens of locations. You can have regional operators, as I said, like SAM, which is a Chilean operator. It's very active in South America, Central America, North America. And I would argue that there's a special case of China as a strategic operator and investor. They have their own set of criteria that they're looking for. but you know, they're definitely within the strategic operator category. This would be China Merchants or China Costco. There are financial investors, and there are at least 2 different kinds, probably 3 or 4 as well, but there are offshoots. So private equity, a good case here would be High Star Capital, which is now part of Oaktree. Then you have pension and infrastructure funds, which really have long-term money that are after long-term returns. You know, have to pay out a pension over many years, and so they're looking to put their money to work today over a long-term period. So Macquarie and Brookfield would be a good example there. And then public, the main investor of ports historically is the public sector. I'm not going to cover that. We have Grover here, who's a specialist on that. But of course, you know, the federal government, states, municipal agencies, port authorities. There's some states have development banks, infrastructure banks. Florida, they have a infrastructure bank that is very active. And so that's yet another source of financing for port projects. In general, what infrastructure investors want, I won't bother reading it, but they want resilient, long-term, stable flows that are resilient to the economic cycle, as well as the other things up there. So now you know who is investing and sort of what they're looking for. So what's next? Because I think a lot of you had projects and were considering, how do I get money for it? So there's a lot of planning involved. Luckily for you, there's now several good toolkits out there, including the AAPA's Port Planning and Investment Toolkit. Blair's going to talk about it a little bit more. I'm just going to cover it and say it's a great addition out there to the specialized expert firms like Moffatt, Nichol, and others who have been here for you, and we now have some tools as well to assist you. There are actually a good number of training sessions that the AAPA sponsored earlier in the year. They're on the web. I found them very valuable, you know, so review them, talk to us. I think it's a great tool, and I look forward to using it with you. So within the tool, they lay out many different steps to take. I mean, numerous studies. But if there's one piece of advice I could give, it's to use a financial model. It's to make regular use of a financial model. So what is a financial model? Probably some of you, this is basic, and for others, maybe not. But I think it's helpful to say what it is and what it isn't. It's essentially just an abstract representation of a real-world financial situation. So it's at its core, it's supposed to encapsulate all of the assumptions that you make about a project and try and quantify the financial impacts. It allows you to ask certain what-if questions and analyze certain scenarios. And it's for the life of a project. And for ports, these are sometimes 30-year contracts or 50-year. You know, the life of the construction is 50 years, so you're trying to tell the future for a long period of time. So what is it not? It's not a black box where you plug in some numbers and out comes the one right answer. It's merely a tool that should shape your thinking, how you think about a project, to make sure that you've adequately examined all the risks and possibilities. Now, you will be wrong, it will be wrong, but at least you've systematically examined what you think could happen and what the implications would be. So let's get into some of the trends well, global trends in this case. It feels like it's getting harder to tell the future, and that's what a financial model does for you. It feels like there's more uncertainty over global economic policy. I'm not talking about political uncertainty. I'm talking about global economic policy. These are policies about the flow of goods, money, and people. And in fact, there is some evidence that there is more uncertainty today. You know, the flow of money, goods, and people, these policies have largely been in place since the end of World War II. I mean, so we're talking decades of stability here. But this isn't the only source of uncertainty, and really it's not necessarily even the most important source of uncertainty, because there are some near-term and medium-term changes in the shipping industry that I think are driving changes that will be more important, more relevant to the near-term success of port investment projects. and that will have, for port authorities with multiple mandates of trade promotion or regulatory or even operating mandates, it's important to understand some of these trends. The private sector is struggling to understand them as well. So a financial model starts with top line revenue, volume, and prices to get revenue. So let's talk about volume. And I think here there's a great deal of commercial uncertainty today. On average, volume growth is not as exciting as it was in the 90s and 2000s. I think you see, if you look at volume growth as a ratio of GDP in the last several years, it's been barely above the rate of GDP growth in the US. This is pretty low by historic standards. And furthermore, market share is moving around a bit. I mean, since basically 1985 to 2015, you had pretty stable coastal share of US cargo at 50, 40, 10%, West Coast, East Coast, Gulf. And now it's starting to fluctuate, and I think it's going to continue to fluctuate. This is happening coastal in the US, it's happening within ports, and it's happening within terminals. That's not to say that everyone is seeing a slow growth picture. Some port authorities here today have experienced pretty decent double-digit growth this year. But it is to say that it's no longer a matter of picking, a multiple of GDP, be it 3.1 to 3.2, plugging it into the financial model and calling it a day. We're now seeing a divergence of results. We're also seeing a tremendous amount of consolidation in the liner industry. This has been talked about earlier today. It's been talked about in the press. It's a well-established trend. Carriers are consolidating a result of their own supply and demand challenges. That's giving them more negotiating power with terminals and port authorities and raising the stakes for success or failure. Winning or losing a customer for a terminal today no longer means the difference between 3% or 3.5%. It can mean 50% or more loss of volume in any given moment, or gain. To put some numbers to it, in 2006, the top 10 carriers had 53% of the market. This year it was 76%, or last year it was 76%. And with the anticipated changes coming, I've got a couple of those listed, that market share will increase to 84%. That's a tremendous growth in consolidation at the carrier level. So that means that private investors are going to be increasingly looking to partner with carriers or terminals affiliated with carriers to mitigate volume risk and transform some of that into credit party risk. That is, instead of the vagaries of the market, I'm going to be looking to somebody with a balance sheet to enter into an agreement with me. And that is a role that carriers have historically not wanted to play. So it's going to be interesting to see how that dynamic plays out. It's also important to remember that these alliances have changed very rapidly in a short period of time, and they're going to continue to change. These are not set in stone. The alliance members that we see today grouped together probably won't be the same alliances in 5 or 10 years from now. And when you're talking about a 30 or 50-year concession agreement, you have to keep that in mind. Consolidation is trickling down to terminals and port authorities. I think we're seeing, just look in LA and Long Beach alone, with the Japanese lines forming the Ocean Network Express. We're going to see 3 lines with 3 terminals, and interestingly enough, with 3 different financial minority investor partners. When China Costco completes their acquisition of OOCL, they too will have 3 terminals in LA and Long Beach. So consolidation is going to happen and is happening in the Pacific Northwest. Portland had to close their container terminal, and you see the ports of Seattle and Tacoma coming together to manage their investment and development of ports in a comprehensive and coordinated way. And in Gulf and Eastern seaboards and in countries around the world, you see ports investing in infrastructure to handle larger vessels to remain relevant for containerized trade. So it's a very complex environment, but out of this complexity comes an opportunity to realize your public policy goals if you're a port, or to realize your private investment goals if you're a private investor. I'll try and speed this up on behalf of my fellow panelists here. So I guess one more trend I want to cover. So we're seeing valuations increase in the port space. Ultimately, private investors need to see their investments pay off. So the most common way to look at valuations is enterprise value to EBITDA ratios, and that's what these numbers are here. I can explain to you offline how that is, or what that is, but basically we're seeing a lot of deals sort of in the 8-9 range, and then a lot of them in the 14-15 range. Now, why does that matter to a port authority? Because you don't get money if there's a private transaction between one investor to another. For two reasons. If the valuation creeps unrealistically high, it puts the investment at greater risk, and risks jeopardizing the public policy goals you established in the first place when you decided to enter into a PPP. On the other hand, if valuation isn't high enough, it won't capture the interest of the investor community. So ultimately, this goes back to the goals of a PPP, and my sort of advice to be very clear on which goals you prioritize, and then be flexible on the rest. I'm going to close with three very brief mentions of some long-term trends that I think are worth keeping an eye on, because ports are part of logistics, and logistics is a chain. So one change further down the chain is bound to impact ports as well. The first is sort of the rise of e-commerce, which is a well-established trend. But an even newer trend within that is something called mobile snacking. Jim Tompkins coined the phrase. It's a really good one. So it's basically ordering one or two things frequently throughout the day, whereas before you might have placed an order with Amazon, one order at night on your desktop for 20 different items. Now you're ordering 20 different things one at a time. So the pressure on logistics is increasing exponentially as a result of this. Combined with our expectations for 2-day delivery, and in some cases 2-hour delivery, it's managed to fundamentally reorder retail, commercial real estate, and industrial real estate. It's moving smaller warehouses closer to population centers. It's putting larger warehouses where we wouldn't have thought to have them before. And of course, it's wreaking havoc on malls and brick and mortar stores. One example is in Mobile, Alabama. They now have the infrastructure to legitimately and cost competitively serve the U.S. hinterland, the Midwest hinterland. And Walmart's putting in a very large warehouse right outside. I mean, I don't think anybody imagined that Mobile would be serving the greater U.S. Midwest hinterland 20 years ago. Autonomous vehicles is another technology I think is worth keeping an eye on. It's not quite here yet, although it's a pretty cool example. But it is coming. Autonomous personal vehicles, they have the potential to fundamentally reorient where we live in terms of the urban-suburban divide. There's a really interesting piece by Alan Berger on the suburb of the future. So where we live impacts how we buy things and how they're shipped to us. And I think this and how we get to work. So this, I think, has a potential to really make some really interesting changes to the logistics supply chain. Autonomous trucks, I think, have the potential to fundamentally change not just the economics of the logistics supply chain, but the ease of it. So by way of example, I think it will reduce not just the cost, but the availability of equipment, trucks and chassis. So I mentioned earlier that the Port of Portland had to close their one container terminal, leaving approximately 3,000 heavy grain exporters without cost-effective and reliable access to ports. Could it be that autonomous trucks make it feasible for them to get their goods to market? And if so, is there a role for the Port of Portland Port Authority to try and help make that happen? That's an interesting question to think about. My last trend is data and context as an asset class. And we're pretty far afield from civil infrastructure, but it's interesting to take a look, I think. So Chris Surdak is a noted technologist and futurist. he compared the valuations of companies today versus 20 years ago. And what you see is that the vast majority are somehow related to data or its context. So what's a context engine? Uber is a context engine. They don't own any cars, but they're more valuable than Volkswagen, and they threaten the global taxi industry. Airbnb is a context engine. They don't own hotels, but they're more valuable than Hilton. And Amazon is a context engine, and it's gobbling up everything. So why is this relevant to you? So a port's greatest asset is its infrastructure. A carrier's greatest asset is its ships. But stock market investors are now placing a greater value on data and its context than any of these other assets. So the question is, what data do you have? What data could you gather if you have the role of trade promotion and regulation? And what could you do to help collect and analyze data that would provide you and your stakeholders with something valuable? Because when you have something valuable, you can contribute it to a public-private partnership and help you realize whatever goals you may have. So that's the end. I'll turn it over to Blair, and thank you very much for your time.
Good afternoon. Hope everybody's enjoying the conference. Thank you for the introduction. And Josh just gave us a really good summary of a lot of the pressures, challenges, and opportunities facing ports as we move forward into funding very important projects, whether they're new development, maintenance, retrofitting existing facilities, purchasing equipment. There's a lot of different types of ways we invest in our port facilities and our operations. One of the challenges we have is obtaining the money. And as a port consultant, similar to Josh, we help a lot of port authorities with obtaining grant funds or private financing, a lot of due diligence work on the buy and sell side, and helping port authorities position for funding and or private financing or the combination of the two. If you look at the historic funding from Tiger grants over the past several years, there is quite a large ask, and a very small portion of that request is actually funded. Of that $5.2 billion, only about half of that, or less than half of that, goes towards freight-related projects, and a portion of that is provided to port authorities. So it's a very competitive environment out there, and if we just look at last year's infra grant financing, the trend's exactly the same, very similar. On the private side, it's the same story. When Josh asked the question about who gets the calls, I have money, I need to invest it somewhere, that doesn't mean they're going to give you the money. You still need to compete for that money. And one of the things that we've struggled with in this industry in the past is knowing where to go, what we don't know, and maybe how to get there. And AAPA and the U.S. Maritime Administration decided to change that and develop what's called the Port Planning Investment Toolkit. And this is a very unique toolkit that looks at all of the levels of obtaining port financing. This toolkit was developed by the port industry. That's many of you in here. In fact, who in here actually worked on this? Stand up if you can, please. Come on, stand up. Look. Thank you for your participation. Many, many more people worked on this. In fact, there were over 64 participants and volunteers. There were PPM candidates. I was one of them, who volunteered time to develop the toolkit and provide it to the industry. And I'm going to spend some time today describing what's in there, because not everybody comes from a finance background, not everybody's a planner, not everybody's works on due diligence projects. So maybe this will give you a little insight into maybe some of the content that could help you in your everyday business, or help you if you're tasked with a larger project financing goal. So there's 3 key elements to the PPIT, or the toolkit. The first is planning, how you define, how you identify what your project is, and really drill in and being able to help sell that project to financing agencies and to funding agencies. The next is how you evaluate the feasibility, how you measure and then evaluate that feasibility. It's very important, especially on public funding requirements. And then finally, how you strategize and structure your financing. At the end of the day, your plan needs to be balanced with your feasibility and your funding strategy, or your financing strategy. So I'm going to walk through a couple of the modules of the toolkit to give you an insight into the content. I'm going to talk about the planning module first, and go through the feasibility module, and then Tony's going to provide some insight into the final financing module in his presentation. Project planning, from inception all the way through to development and implementation, is an iterative process. And it begins with defining the project and moving forward. And so as you begin to define your project, in the initial stages, you need to identify your goals and objectives. And this sets a good, clear direction that you're heading in, but it also is useful later on in the project when you have to evaluate it. And you make sure you're aligned with those goals and objectives, and we'll talk about that in a minute here. Data collection is important, and it's not just going out and collecting information about the project that you're developing, 100-foot deep wharf by 1,500 feet long, or 100, 200 acres of backland. It's really digging into the key elements of not just infrastructure, not just operations, but understanding the market requirements, the strategy behind it, and obviously the financial requirements. Stakeholder participation and collaboration is key. Obviously, you're never going to get 100% cooperation or participation, but this is a very important step in the planning process. You need to engage your stakeholders early and make sure that they're involved in the decision process, so that if there's something that they don't understand or don't necessarily agree with, they can be part of it and really understand why that's a very important element of the project. Continuing on and quantifying your project, existing conditions are important. Where are you starting from? What's your baseline? Do you have an existing facility that you're expanding? Is this greenfield? Is it brownfield? We need to really understand what we're beginning with, because ultimately on some funding applications, you need to evaluate your project or your options against doing absolutely nothing, which is maintaining where you're starting from. Next is really looking at the project drivers. This is some of the stuff that Josh was talking about earlier. What is the market opportunity? What is the growth strategy? What's going to generate that revenue? And really push the decision and the opportunity to invest in your project. You really need to identify that and understand what are the key elements related to it. Next, we need to then start quantifying those project drivers into tangible elements: infrastructure, equipment, operations. Compare that against your opportunity, your forecasted opportunity. Identify the capacity gaps that you're going to meet. This might be purchasing equipment, it might be changing an operation, it might be developing new infrastructure. You need to balance that with the time-sensitive approach of capturing as much market as you can at this initial stage. You then have the information to begin developing your alternative approaches. These can be infrastructure plans, or the equipment acquisition that I just described, or some combination of the two, or an operational change. but you need to develop your alternatives that you can evaluate in the follow-on processes. You take that capacity analysis I described before and you forecast it out. When you get to the financing level, you're not just looking at the end state of your project, you're looking at the life cycle of the project. And you really need to be able to communicate that to potential financiers or to grant agencies. So you need to forecast out how you're going to invest that money and what those costs are. Are they operating costs, or are they capital costs, or the combination of the two? Then you can move into evaluating the feasibility. And this is the second module in the toolkit. And one of the things that we wanted to focus on is in the project process is the iterative effort that you go through. As you begin to evaluate feasibility, you will be keeping an eye on the fact that you're going to go back and do some planning later on. Your planning is not finished. And you're going to do that additional planning to refine your projects and your alternatives so that you maximize the potential feasibility of your project. Obviously, you begin with measuring a few things. The physical and operational characteristics I talked about a few minutes ago. The market and financial performance requirements. We need to measure the baseline and where you're going to obtain that highest level of feasibility in the future. And then we want to look at comparative costs. And this is where we take those cost schedules and we look at each alternative one by one and we compare them against each other. An easy way to do that is to evaluate that on net present value so you don't have to deal with the forecasted schedules, but you can evaluate the potential cost impacts of different projects. We then measure the impacts, the beneficial impacts, the cost impacts, economic, environmental, and we quantify these impacts. Sometimes it's easy to quantify them, sometimes they're a little bit more subjective, but you need all this information to then start looking at the risks. And Josh talked about this earlier. When financiers are looking at projects, they're looking at the best way to mitigate or manage risk. And typically in the planning and the feasibility stages of your projects, that's where you quantify it. Cash flow. It's not just the net present value of each option. It's also how much debt are you going to accrue over the life cycle and what's the payback period. You need to start thinking about things in the life cycle process when you're in feasibility, not when you get the finance, but earlier on in the planning and feasibility areas. And then benefit cost analysis, especially on funding programs. Evaluating those economic benefits and the costs that you compare to that to determine what benefit that's bringing to a community, to stakeholders and the like. And then finally, you can feed all this information into an evaluation tool. There's many out there. I'm sure many of you have your own tool, evaluation tools that you like to use. But this is essential so that you can not only finally identify the most feasible option, but it'll help you as you go into financing as well. So the finance module. Looking at your financing strategy and identifying the structure that best fits your project and your port authority or your business line. Tony's going to talk about this a little bit more, so I won't go into any detail here, but I did want to let you know that this is a major component and probably the focal component and module of the toolkit. There's many resources in the toolkit as well. It's not just a how-to guide on how to go through the project process. There are some financial models, very rough and rudimentary, probably not what Josh would develop on a larger scale on a more detailed project, but it gives you some insight. It gives you some understanding of what you're up against. We also have several different resources for helpful additional tools. We also have a checklist. Maybe the entire toolkit isn't what you need. Maybe you only need a few elements and you can go through the checklist and get to exactly what you need when you need it. And then probably one of the most important parts of the toolkit is the glossary of terms. And you might think that Why would you say that? Well, planners use certain terms and speak in certain languages, and financiers use certain terms and speak in certain languages, and you almost need a translator sometimes, even when they're saying the same thing. And so we've combined that information into one resource in the toolkit. If you want more information on this, there's two places you can go. One is booth 102 in the exhibit hall. U.S. Maritime Administration has copies of the toolkit. You can pick one up today. Another resource is online. You can download all the information, and you can also access the additional resources like the financial model and a few of the other resources. Thank you for your time, and I'll look forward to your questions at the end of the presentation.
Okay. Well, thank you all very much, and I'm fully aware that it's been a long day, and the only thing standing between you and a cocktail party is me and Grover. So I will try to move this along. Again, thank you very much for inviting me to speak here today. So I'm going to very quickly focus on transaction structures and financing alternatives for large projects involving private investors primarily. Also, I'm going to, as Blair mentioned, discuss the finance module of the toolkit. So to start, I think everyone can agree that the outlook here is that there's significantly more need for capital than there is capital. The AAPA study that was released last year identified just in the port sector the deficit to be over $120 billion over the next 5 years. So we need to find ways to close the gap. I think one thing that's helpful, one of the few things that's helpful in Washington right now, is there's a lot of talk about infrastructure and infrastructure plans. And President Trump's initial plan, I think, is a step in the right direction. It's a big number. It involves public and encourages private sector involvement in the infrastructure projects. But it's Washington, and who knows what will get done. And even over the last few weeks, I understand that President Trump is backing off of his sort of insistence that the private sector participate in any plan that goes forward. So maybe we'll hear more about that later. But anyway, if something does happen, it'll be a great catalyst to bring more private equity, private investment into infrastructure projects and port projects in particular. But if they do nothing in Washington, there are a lot of private equity asset managers and other investors who are very interested in infrastructure spending. A couple studies I've looked at, just in the United States, there would be over $100 billion of dry powder next year from different private equity firms that are organizing funds for the specific purpose of investing in infrastructure. I'm not going to go through in a lot of detail all of the aspects of this slide. It really kind of lays out what's going to be discussed in the rest of the presentation. A couple things just to set the stage, though. When I'm talking about most of the structures that we're going to go through here, I'll be talking about private public-private partnerships. And that's typically where there's a private agency that enters into a contract with a special purpose vehicle that's been organized by private investors, and it'll be typically a long-term contract. The debt equity investment mix, I'll talk about this a little bit more in detail later, but there'll typically be the private equity or the private investors who set up the special purpose vehicle will capitalize it, and then they'll find bank loans or capital markets debt to finance the project. In some cases, the public agency will issue private activity bonds, which is tax-exempt bonds that are issued for the purpose of raising capital to give to the private investors to use for the project, and as long as it's used for a public purpose, the bonds would be tax-exempt. And there's a few different structures for these public-private partnerships. You have, sometimes it's a long-term lease essentially, or a concession, and there's another structure where there's an availability payment where the public agency will make payments on a regular basis to the special purpose vehicle that was organized by the private consortium. once the asset or the project is completed and it's available, and then they'll maintain the project for the life of the contract. Another thing to keep in mind is there are regulatory aspects that can be important here, such as antitrust considerations and foreign investment considerations. So when we talk about private sector investors, who am I talking about? Well, pension funds, and as Josh mentioned, pension funds are always interested in long-term, steady returns on an investment, particularly when it's a good credit rating on the other end of the contract. There are infrastructure and private equity funds. There are sovereign wealth funds. We're working with a number of sovereign wealth funds that are very interested in U.S. infrastructure investments, particularly ports and airports. So there's a lot of money coming from abroad that's interested in these investments. And there's strategic industry participants and institutional investors. And you'll almost always, in a public-private partnership, be dealing with a consortium of investors. It won't just be one of these types of investors or the other. Now, why are they interested? Well, again, some of this has been discussed before, but they're interested mainly because it's a long, sustained, and predictable cash flow. Everybody likes that, and particularly, again, if it's good credit risk on the other side. There are barriers to entry. They kind of speak for themselves. You can't just set up another port next door. There's limited competition, and there's acceptable risk-adjusted returns. Now, this is actually something that I think is an important development. For many years, particularly private equity money needed significant rate of return, over 20%, and that's how they marketed their funds. But now a lot of the infrastructure funds that are being set up are marketed in a much different way. They don't need to have such high returns anymore, and that's allowing them to actually make investments where they're not going to make maybe as much return on each investment, but it's a longer term investment, and it's more permanent capital. And then of course there's reputational enhancement. Who doesn't want to be associated with getting an important infrastructure project over the finish line and all the good things that go along with that? So as I said, there's a lot of private sector money out there, and it's just a matter of how do you go about accessing it. And this is just a quick snapshot of some of the bigger names from private equity world that are actually focused on and setting up infrastructure funds. And as you can see, 2016, 17, and into 2018, there's a significant amount of money being raised specifically for these purposes. So accessing private capital, what are the considerations? Well, at the end of the day, it has to make sense for the public agency, and it has to make sense for the investors. And it's not just a financial analysis. There's a lot of risk shifting that takes place in these arrangements, where you move a lot of the risk associated with the project, including ongoing maintenance for 20 or 30 years, from the public agency to the private sector investors. So when you take into account all the factors, and one of the things we'll talk about later is sort of how the toolkit helps to do that. When you factor all these things in, you have to say, A, does this make sense for both parties? And B, is there a political consensus around the project? It requires a lot of stakeholders to be engaged in the process and happy with the outcome. Need for an exit mechanism. For many years, one of the big hurdles for private equity investment to come into these sorts of investments was they had a 10-year, typically up to a 10-year horizon for the investment, and they needed to have an exit. Again, a lot of the infrastructure funds that are being put together now are more permanent capital base. It's not completely gone, but it's changing in terms of being the hurdle that it was before. And project scale. $15 million projects are probably not suited for these types of investments. I don't think it's interesting either for the public agency or the private consortium. There's a lot of upfront work. There are complicated contracts, a series of contracts that have to be entered into. There's a lot of time and effort that has to be put in by the agency itself, and a lot of advisors have to be hired. So the cost associated with it probably wouldn't make sense if it's not a significant investment. At the same time, private investors are really not that interested in going to all the trouble to put this project together and make a $15 million investment. $100, $200 million investments are and up are much more, I think interesting for both sides. And transparency obviously speaks for itself. So, you've done your planning, you've looked at the feasibility and decided this is a project we really want to finance. How do we go about doing it? well, and most of these projects, and a lot of projects of this size, whether we're representing, private equity firms or people organizing the project, there's a lot of different work streams. There are a lot of different areas of expertise that all have to be brought together. Figure out what structure you want to pursue, and then how to pursue it. And one of the best tools I've seen for organizing all these various work streams and different interests that have to be taken into account is the toolkit that Blair outlined, discussed earlier. I think if you look at if you look at the way that this is structured, the finance module, it takes you through steps for how to strategize. What's our investment approach? What have we done the due diligence here that we need to do so that we understand the project and the party that we're seeking to finance this can understand the project? What's the credit profile of the transaction? Once you get some of these things organized, then it goes into the structure of the project. What do we want to do? Do we want to do a typical municipal financing structure? Do we want to try to approach a public-private partnership? And it walks you through in very good detail how to think through the issues that are going to come up with the different types of structures. And it also takes into account the fragmented nature of the industry. There are some big ports, there's some small ports, there are good credit ports, good credit ratings, and some with not so good. So there are ways to approach these projects in different ways. So when I say approach, what are we looking at here in terms of due diligence, the financial due diligence? So you're going to obviously prepare, as has been discussed by both Josh and Blair. I'm not going to go through this in any detail. It's really more their area anyway. But you're going to have to put together revenue forecasts. And one of the important things here is what's the operations and maintenance costs for these projects over 20 or 30 years? What's the renewal and replacement cost? Because it doesn't go in a straight line. There are, there's ebbs and flows, and you'll have to make sure that you can finance these projects over a long period of time. And you'll see that as you start to do this analysis, the different considerations that will come into account, and it'll be used as you work your way through this. So I think you can see is that this is just one example of how the toolkit, in particular the finance module, helps to organize the planning and the structuring of a transaction. So this slide, I think, lays out in nice detail sort of one extreme to the other. You have up in the upper right-hand corner of the slide sort of the traditional approach. You'll design, you'll put out a bid for someone to design and build either a terminal or some other asset that you need at a port, and they'll build it, and they'll come in. You'll have a number of bidders come in. They'll all try to be the lowest price and meet your specifications, and then you'll go into the municipal bond market and you'll finance the transaction. So that's one approach, and you'll get the lowest cost for the asset. What that doesn't take into account, though, is that you'll then have to go out and hire somebody or contract with somebody to do the maintenance for the life of the asset. And so you have maybe not aligned interests in terms of the construction and the maintenance and where the costs are best allocated. In the sort of the bottom right-hand corner of the slide, you'll see asset sales, which is essentially full privatization, which I'm not going to spend too much time on that. But there are contract structures, typically involving public-private partnerships, where you'll put out for these consortiums to bid on designing, building, financing, and then operating and maintaining or maintaining the asset for the life of the asset, 20, 30 years. And this does a couple of things. It moves risk from the public agency to the private consortium, because they're putting in a bid, and they're going to either, if it's an availability payment, PPP, they're going to get a payment over time, or if it's a lease, they're going to be paying a lease payment over the life of the project. But what it also does is it aligns, I think, it aligns the interests of both construction and maintenance. So if there are things you can do in the construction phase, use better materials, design differently so that maintenance is easier, If there's a different construction process you can go through that reduces the overall maintenance cost over 30 years, then it may be better not to get the lowest priced asset that can be built. It may be better to pay slightly more to build your asset, or even a fair bit more to build the asset, if you save money over 30 years. So if the same person is building it and maintaining it, and they know that they're only going to get a certain amount of revenue out of the PVP contract, you probably get a higher quality asset, and you know, I think the interest in some cases can be aligned, particularly where there are significant maintenance and operational costs as you move through your project. So let's see, public-private partnerships. Like, the United States is still an emerging market in this area. This has been used outside the United States for many, many years. In Europe, UK in particular, it's very common to finance infrastructure and port projects this way. But in the United States, only 33 states have, and plus DC and Puerto Rico, have adopted enabling legislation. I think there was an interesting study from Moody's that was released about a year ago, where they show there's a slow and steady development of these projects. A number of projects have come online over the last few years, mostly availability payment, public-private partnerships, however, still dwarfed by the size of the infrastructure market, municipal infrastructure market. But the projects are typically on time, because again, the incentives are aligned. If it's an availability payment, PPP, we don't get anything until it's available. So there's a focus on private sector ingenuity and getting things done quickly. The structure, I've talked about this already, I think. One thing I'll say is it's never just one or the other. There's usually some hybrid aspect to it. There can be upfront payments in a lease. There can be sharing of volume increases over certain agreed levels. There can be contingency obligations on the part of either party. And then there are a number of aspects where you want to cover off termination risks. So if you're, for example, the public agency, you're going to typically want the private consortium to put up a bond or some amount of money so that if you have to terminate them for default during the construction phase, and you have to either go in and finish the project yourself or bring someone else to do it, there's some financing in place to cover that. So that doesn't strictly fit into either of these categories, but you know, there are a number of different aspects to structuring these things, and so it's typically a hybrid structure. So availability payment, public-private partnerships, I mean, the goal here is life cycle cost control, risk transfer to private sector, and then improved delivery time and design quality. So all of this is leading up to, I think, the most important analysis in the toolkit, if I'm not wrong. I think at the end of the day, what matters most is the value for money. Obviously, it's cheaper to do financing in the municipal bond market, but if you take the cost over the life of the project and you remove risk from the public agency to private investors, what the toolkit does in this respect is it helps you to price the risk that's being moved. It essentially does a net present value analysis of the aggregate benefit to the public agency for moving this risk over to the private members of the consortium. So then you can better figure out, is this a project where, even though the money's more expensive initially, we got a better product, it was done quickly, and we're not responsible for the maintenance for the next 30 years and all the vagaries that can entail. Maybe this is a better approach. And so what this part of the kit does is it allows you to walk you through how to do this analysis, and so you figure out which structure gives you the best value for your money. Yeah, there's a few slides here I included just so you can see another aspect of the finance modules. It walks you through, for those who may not be familiar, some of the aspects of the public-private partnerships. Why consider the public-private partnerships? How can the approach contribute to project delivery? And then, the value of P3s. Well, aligning public and private interests is important, and so I think, this is just again an example of some of the things that the finance module will help you work through. So how do you structure your project? So there's a public policy aspect to this. Right? You want to make sure that you understand the regulations, the regulatory environment. You want to monitor infrastructure proposals at the federal level. And then you want to be sure that you've developed a deal that has a good value proposition for everybody. You have to actively engage stakeholders at the beginning, during the planning process, during the negotiation process, and after. And then there are a number of legal considerations. So I've mentioned a few times about how we're moving risk from the public agency to the private sector, and that's true. But that doesn't mean that they're just going to take all the risk for everything that could potentially happen. So there are a number of legal considerations that go into these documents, and more that we could actually go through here in this room, but just a few are authorization risks. So A, the private party is going to want to understand that A, you're authorized to enter into the contract, but not only that you're authorized to enter into the contract, but that you're authorized to enter into an agreement potentially to make payments for 20 or 30 years. And then is there an appropriation risk? Does the payment have to be reappropriated every year? And if it does, is there a legal requirement that you do that? And how do you deal with that risk? Where's the source of the financing coming from? One of the things you'll see, I think, is that when you're talking about, I don't know, a terminal, a bulker terminal or a container terminal, those lend themselves to long-term leases. But if you're talking about sort of the common use areas, you're talking about roads and bridges, they don't really lend themselves to long-term leases. They're going to be more appropriate for an availability payments structure for the PPP. So if that's the case, where are the payments coming from? And then you have default and termination considerations. So obviously a critical element to this, and I think this is where there's going to be a lot of tension, is how do you protect yourself if you're a private investor, the public agency defaults? What sort of damages can you get? Are you going to be made whole? Are you at least going to get enough in damages that you can pay off the loans that you've entered into? And at the same time, if you're the public agency, what are you going to do if the other side doesn't perform? And what remedies are available? Well, there's obviously, as I mentioned, during the construction phase, you can have security in terms of a bond or something like that. But there's going to be a lot of costs associated with changing from one party to another, or taking the project over yourself, and you're going to want them to pay for some of that. So the default and termination provisions are, I think, quite important. And then you have to develop an efficient due diligence process. So I think it's important, A, for the port or the public agency to understand the project and all the things that need to get done for it to be successful. But if you're asking someone to come in and potentially look at making an investment, there's a limit to how much people are going to invest just to understand the project before they even decide if they're going to be willing to bid on the project. So having a well-organized and efficient diligence process is important. I'd say I think there's so much money that's being raised for infrastructure spending, and there are going to be so many people chasing deals soon that there may be a higher tolerance for investing in a due diligence process than there was before. And then allocation of risk. So there are some risks that it's not clear that you can move from one party to the other. For example, what if there's unforeseen, construction site issues, or there's a change in law, or things like this that are out of the control of either party, or at least out of the control of the private party. They're not going to take those risks on necessarily. You have financial modeling, obviously very important, and the guys have talked about that already. And then your transaction structure, you want to be sure that it's it's going to be an iterative process. You're going to want to be sure that you've worked through and developed term sheets, and then more importantly, your tender process. The typical tender process normally, request for proposals, request for qualifications, but you're going to want to have clearly laid out parameters for what it is that you're looking for in terms of a term sheet and in terms of contract provisions. And so you'll want to develop a short list of bidders, and then you'll work through in a very sort of iterative way with the short list, so that you develop in essence one set of agreements that form the basis for the public-private partnership. And you'll have all the sort of preferred bidders bidding as much as possible. There's always going to be some differences, as much as possible on common documents, so you can compare apples and apples. And then you need to be very open about financing options. As I mentioned, there's some ability to finance this in the private market, but you can also use some aspects of the public market to help bring down the overall cost of financing. And then, again, there are regulatory considerations that you have to take into account as you, as you're putting this together. So with that, I think I'll thank you very much. And if you have any questions, please let me know. I'll be having cocktails with everybody else afterwards. So thank you very much.
Okay, so to wrap up here, I'll touch on where the federal government can do and our involvement in the infrastructure process. And I think that it follows well the points that my peers have made. One that really stuck out to me is that there is ample capital from the private sector for these types of deals. And we believe our role as the federal government is to help facilitate some of that activity, to try to address some of the inefficiencies in the market that prevent some of these deals from getting done. That's just not on a funding side, that's also on a permitting side and environmental side, with the ultimate goal, obviously, of trying to enhance and stimulate economic growth. So I'll talk a little bit about the President's Infrastructure Initiative, and then I'll talk about two of the Department of Transportation's flagship discretionary grant programs, Infra and Tiger, that are live right now. And I think that will do a good job of sort of explaining how we as an administration think about infrastructure and what projects should and should not be done, what should be encouraged. First of all, the effort to put together the administration's infrastructure initiative has been quite comprehensive and very, very active. This began with a broad outreach, not only across 16 different federal agencies, but also state and local governments, private sector, NPOs, et cetera. And we have tried to remain as engaged as possible with what the private sector, with what industry needs. The timeline, it should still be over the near term. We were targeting 3Q, but with tax reform and the quite full congressional calendar in September, that has been pushed back a little bit, but more or less we are ready to go at the President's discretion. At the end of the day, there's widespread consensus, regardless of where you are politically, that this country needs better infrastructure, that we need to work to get this in place in order to help the country grow, and it's really a matter of how we get there rather than whether or not this should be done. The plan as it currently stands, it includes not only just surface transportation and transportation components like ports, but it's across energy, it's across power, et cetera. And it's meant to be all-inclusive and really sort of bring in, again, a lot of economic stimulus and activity. You've heard the President talk a lot about the amount of money that should be spent. Right now, it is envisioned to be no less than $200 billion, with the goal of that leading to $1 trillion overall spending. The way that math works is through a mixture of both self-help or match. So similar to a lot of the comments that have been made regarding P3s, we want to encourage other capital to come to the table, and projects that do that will be viewed favorably. Also, this is not just meant to be grants, but also meant to include loan programs. And the way that appropriations work in the federal government, for each dollar that is appropriated for one of our loan programs, that can lead to $14 or $15 being actually deployed by the Treasury Department into infrastructure programs. So it's quite powerful in terms of the multiplier that you can get there. These loan programs are very, very flexible in terms of compared to what you may be able to get in the private sector. One thing that came through a lot of our outreach efforts was the fact that ports and eligibility thereof could be broadened, could be expanded. That could help increase activity there, and that's something that we're very, very mindful of as we're continuing to construct the infrastructure initiative. So I'll pivot a little bit there to the infra program. The infra program, the notice of funding opportunity came out earlier this year. Applications are due on November 2nd. Tiger program is due, applications are due on October 16th. And the infra program, the criteria has changed this year, and it does a very good job of putting to paper what some of the core emphases are from the administration for what we're looking for in infrastructure projects. There are 4 key objectives. If you look at that notice of funding opportunity, one is to support economic vitality That's exactly what it sounds like. So it's, are you relieving congestion? Are you improving efficiency? Are you creating activity where there may not currently be activity? Or are you helping to improve the capacity or the efficiency of any type of surface transportation project or area? The second is to leverage federal funding, a point that we've been making. How can we make the federal dollar go as far as possible? There are no shortage of infrastructure projects in this country to pursue. So it's a matter of how can we get the biggest or the most sizable ROI on each federal dollar. That ROI is not necessarily what it may be in the eyes of the private sector, but it's what is the best return to the taxpayer in terms of job creation, in terms of GDP, in terms of long-term sustainability of local and regional and federal nationwide economies. The third is innovative approaches, and that has a few subcomponents: project delivery, safety. At the end of the day, safety is always the #1 focus of the Department of Transportation, and so projects that not only talk about what they can do in terms of capacity or growth, but that also focus on a safety component that will be taken into account. And lastly, accountability. So this is not mandatory for project applicants, but those who come to us with a plan that consists of whether it be milestones or other sorts of specific targets, and they tell us, well, if we do not hit those, some funding could be withheld, then we view them as showing a willingness to be a partner. And so that is new criteria that was added this year. Again, we know that not every single applicant will want to consider something like that, and it is optional, not mandatory, but we believe that it does represent a commitment to project expediency, a commitment to actually earning the federal dollars beyond the initial obligation. Beyond those, one of the main priorities that we have at DOT right now is data. So any sort of data-driven approach to your success, to how you measure your progress, that will be viewed very favorably, and that's not only in project delivery, but again, back to safety. It's similar to accountability. If we can look through what you're showing us and we can see what that progress is over time, then that gives us a lot of confidence in selecting a specific project. On Tiger, the criteria is largely the same year over year. Between the two programs, infra is $1.5 billion of availability. There are some restrictions in terms of how much can go to intermodal freight, but there is ample capacity this year. The Tiger program has $500 million. And again, I would be remiss if I did not give a nod to our loan program, specifically TIFIA, which has support eligibility. As it was noted earlier, the grant programs, as great as they are extremely competitive. It's sort of like applying to an Ivy League school. You will be somewhat fortunate to get one with the oversubscription, but our loan programs have quite ample capacity to do more volume, and we're having quite a standout year to date in terms of what we've been able to process. So with that, I guess we can move to a little bit of Q&A, and happy to talk more.
Thank you, Grover, Tony, Joshua, and Blair. Now we can take a few questions if folks have some questions that they'd like to raise to the panelists. If you'd raise your hand.
Grover, in the federal government approach now, is it going to be less of trying to spread money around to a lot of different projects and more prioritize fewer projects that are maybe of more national significance?
So I won't say that that's an explicit goal. It's not the size of the project that is the emphasis. It is true to your question that the significance of the project is what we're focused on. So a small project can have quite large economic effects for that specific region or that specific municipality. In addition, there is also an emphasis on rural under this administration. So the infra program has always had a specific allocation to rural, 25%, but we view that not as a target, but really as a minimum. And so there are a lot of areas in the country that have need, both rural and urban, nationwide as well as regional. And so really we're just looking for the best return on the taxpayer dollar.
Another question? Okay, if no other questions, let's give our panel a round of applause. Thank you again, gentlemen. We appreciate you taking the time to be with us. As a reminder, the Port of Valparaiso will be hosting us this evening for get us to be ready for next year's convention. The buses will be leaving your hotels beginning at 5:45, so we look forward to seeing you this evening. Thank you very much.